US households are showing mounting signs of financial stress as credit card delinquencies, student loan arrears, and falling credit scores converge to paint a worrying picture of consumer credit health in late 2025. Credit card balances have surged to a record of $1.21 trillion in the second quarter, and the share of account 19 days or more past due has climbed above 7%, the highest since the immediate aftermath of the financial crisis. Rising delinquencies are not only straining households' budgets but also raising alarm bells for banks and lenders, which now face higher charge-offs and potential lightening in credit supply. The deterioration is not limited to revolving credit. After the end of the pandemic era on ramp protection in late 2024, federal student loan borrowers who have missed payments are once again being reported delinquent, pushing the share of loans in serious arrears sharply higher. This has fed directly into credit scoring models. Average FICO scores, which had steadily risen through much of the last decade, fell from 717 in April 2024 to 715 a year later, marking the steepest one-year decline since the Great Recession. The decline is most acute among young borrowers, particularly Gen Z, who are entering adulthood with rising living costs, heavy debt burdens, and relatively weaker wage gains. The roots of this stress are clear. Interest rates remain elevated after years of Federal Reserve tightening, leaving credit card annual percentage rates at historically high levels, often about 20%. For households carrying balances, this means interest charges consume a growing share of monthly income. Inflation, while lower than in its 2022 peak, continues to erode purchasing power, with essentials like food, housing, and energy absorbing more of household budgets. Pandemic-era savings cash-ins built up from stimulus checks and reduced spending have largely been depleted, particularly among middle and lower income groups. This leaves many families exposed to shocks such as medical bills, rent hikes, or unexpected job loss. The, con- the consequences extend beyond individual households. Consumer credit health is a key pillar of the US economy, which depends heavily on households spending for growth. As more income is diverted to debt servicing or lost to delinquency, discretionary spending falls, slowing demand for goods and services. For lenders, the rise in the delinquencies translates into higher provisions for losses and weaker profits, which may push banks and card issuers to tighten underwriting standards, raising rates further, or reduce available credit. That, in turn, could create a feedback loop where reduced access to credit amplifies financial strain and slows consumer activity. The stress is not evenly distributed. Data from the Federal Reserve shows delinquencies climbing fastest in lower income zip codes, where borrowers have fewer buffers and higher reliance on credit cards for everyday expenses. Meanwhile, younger borrowers are juggling with multiple forms of debt, including student loans, auto loans, and rising rents, leaving them particularly vulnerable to financial setbacks. Even consumers with stronger credit profiles are beginning to feel the pinch as credit utilization rises and lenders grow more cautious. Looking ahead, the trajectory of consumer credit health will depend heavily on macroeconomic conditions. If inflation continues to ease and wage growth remains solid, households may gradually regain footing. But if the labor market softens further with slowing job creation and weaker wage gains, the risk of a broader credit downturn increased sharply. Rising delinquency in credit cards and student loans could spill into other categories like auto loans and mortgages, with broader implications for banks, investors, and the overall economy. Policymakers will be watching closely for signs of contagion, but options are limited. Lowering rates prematurely could rekind of inflation, while doing too little may worsen the credit squeeze. For now, US consumers remain under pressure, and the balance between resilient spending and mounting debt distress may define the next phase of America's economic cycle. The growing strain of households' finances is beginning to draw attention from policymakers, regulators, and financial analysts who view consumer credit as a critical early warning system for the broader economy. Historically, spikes in delinquency have persisted recessions as overstretched consumers cut back on spending and defaults ripple through the banking system. Today's situation is particularly complex because it combines high nominal balances with elevated interest rates, weakening credit scores, and the appearance of student loan stress after a long pause. Unlike in 2008, the issue is not primarily exotic mortgage instruments, but rather the day-to-day financial pressure faced by millions of households across the income spectrum. Banks and credit card issuers are responding by tightening lending standards. Surveys conducted by the Federal Reserve show a growing number of institutions reducing credit lines for subprime borrowers, increasing required minimum payments, and imposing stricter income verification. These measures may reduce their exposure to losses but risk deepening the financial strain on consumers who rely on credit for essentials. At the same time, fintech firms and non-bank lenders are stepping in to fill the gap, offering buy now buy later services or high-interest installment loans, which may provide short-term relief but could worsen long-term debt burdens if not carefully managed. This creates a shadow credit channel that regulators are struggling to monitor in real time. The stress in consumer credit markets is also influencing investor sentiment. Bond markets are beginning to price in higher risk premiums for asset-backed securities linked to credit card and auto loans, suggesting growing concern about repayment capacity. Equity investors, meanwhile, are squinting quarterly reports and from banks and consumers finance companies for signs of rising charge-offs or a slowing loan growth. A sharp deterioration in credit metrics could trigger wider volatility, especially if markets begin to question the resilience of household spending, the backbone of US GDP.